Our approach to value investing is to build a portfolio of stocks in the developed world from the bottom up. And we'll focus on a number of key financial metrics at the individual company level. And we'll have a keen appreciation or understanding of the industry fundamentals that that business faces. Ultimately, what we want to identify are businesses that we perceive the market has mispriced, and that for a variety of reasons we believe may be able to improve the returns on capital, improve the operating margins, reduce the underlying cost base, and ultimately reward us as shareholders with higher cash flow, higher earnings, and higher dividends. Our focus when we look at companies is to also focus on the underlying industry fundamentals. But we don't have a broad-based top-down view of the economic environment that is impacting all companies. Our perspective will be one as it relates to the industry fundamentals and where the company lies with respect to those industry fundamentals. Now, admittedly, industry fundamentals are going to be influenced by the broader macro conditions. But we don't employ a methodology that is designed to predict what the rate of economic growth in a particular geography happens to be. The primary reason for that is that, particularly in the developed world, companies' domicile can very often be quite misleading as to an indication where the company does its business. And because a company is listed in the UK or listed in France or Japan or any of the developed markets in particular, doesn't necessarily imply that that company is going to have its operating conditions influenced in the geography of its domicile. So we think it's much more important to look at where the company does its business, who they're competing against, and what are the underlying conditions of the industry that they operate in. We do not have a star system. I often refer to it as a very flat structure. Nobody at the top of the pyramid making all of the decisions. There are a number of reasons that underlie our decision to go down that road. And that it's primarily to protect the investor. The investor sees an image in the rearview mirror as represented by the track record. And to the extent that that track record is dependent on the decision making of one or two individuals, then it becomes a very vulnerable track record in time. And so our emphasis has been very much to devolve the research responsibility down to as flat a structure as we possibly can, allowing all of the research analysts to present an investment case and have that investment case reviewed by a group. And the group will sign off on that investment case. And based on a risk-adjusted ranking that we employ, if the stock has a competitive risk-adjusted return, whether the most senior person in the organization or the most junior person in the organization has presented the investment case, once the group has validated the return expectation for that security, if that security's risk-adjusted return is competitive, it'll end up in the portfolio.